the credit union broadcast experiences. Cube TV.
Hi, I'm Gloria Ledoux, bringing you an overview of the 2015 mortgage amendments at the CU Compliance Connection by InfoSite, only on Cube TV. This presentation is going to provide you with an overview of some of the monetary thresholds updated in the CFPB rules associated with consumer pricing indexes, and also some rules that became effective that may impact your mortgage lending policies and procedures. We will discuss the high-priced mortgage loan appraisal requirements, high-cost mortgages, QM, which is the qualified mortgage points and fees, and the qualified mortgage cure provision, high-priced mortgage loan escrow requirements, HMDA revisions, loan estimate form, closing disclosure associated with the integrated mortgage disclosures, and restriction on fees, the escrow closing notice, and the partial payment disclosure. So a lot of people are focusing on both the integrated mortgage disclosures and only the closing disclosure and the loan estimate, but really there were some other provisions that credit unions are going to have to think about, so we're going to talk about that. And it's a lot of information, so we better get started. Under the high-priced mortgage appraisal rules, there are certain loans that are deemed to be exempt from the requirements. For example, qualified mortgages, reverse mortgages, etc. There were 3 new exemptions added after the final rule was adopted in January of 2014. Those rules include an exemption from certain streamlined refinancings, such as the credit union refinancing their own loan, and transactions secured in whole or in part by a manufactured home, which will become effective in July of this year. However, one of the exemptions was for an extension of credit of less than $25,000. This was recently increased based on the Consumer Price Index for urban wage earners and clerical workers that was in effect on the preceding June 1st of 2014. So now, extensions of credit under $25,500 would be exempt from the high-priced mortgage loan appraisal requirements. So based on the index, now credit unions have that additional $500. The Home Ownership and Equity Protection Act, or HOEPA, governs the high-cost mortgage requirements, which require specific disclosures, restrictions on transaction terms, fees and practices, and have specific ability to repay requirements and a pre-loan counseling requirement. In accordance with the Consumer Price Index for all urban consumers, the CFPB adjusted the points and fees thresholds to determine if a loan is considered a high-cost mortgage. So now loans with points and fees exceeding these thresholds will be considered high cost and subject to the additional restrictions. For a loan to be considered a qualified mortgage, the loan's points and fees must not exceed certain thresholds. These thresholds were also increased at the beginning of this year, 2015. The loan amount is the amount financed minus points and fees that are rolled into the loan. Credit unions should review the requirements within Regulation Z to determine that they are correctly calculating the points and fees for the qualified mortgage rules. Credit unions must maintain and establish escrow accounts for first lien, high-priced mortgage loans for at least 5 years. Remember, this does not apply to subordinate liens or HELOCs. However, if you have a fixed home equity in first position, the escrow requirements will apply if the loan is considered to be a high-priced mortgage loan. The CFPB made adjustments as a result of the Consumer Price Index. Therefore, to qualify for the small creditor exemption, credit unions have to originate more than half of their loans to members in rural or underserved counties, together with affiliates, not originate more than 500 first lien covered transactions in the preceding calendar year, and have assets of less than $2.06 billion. And the credit union or their affiliates cannot maintain escrows already for any of those loans serviced. There are also changes in the HMDA reporting thresholds. Credit unions with assets now of $44 million or less as of December 31st, 2014, are exempt from collecting data in 2015. So last year the threshold was $43 million, so the CFPB has increased that. Although we've already talked about these changes in our quarterly compliance, it's important to reiterate that the ability to repay cure provisions became effective for credit unions in November 2014. Again, this allows credit unions that originate qualified mortgages who later determined that an error was made in calculating the points and fees to actually cure that overpayment and refund the fees, so the loan can still be considered a qualified mortgage. There are certain criteria that the loan must meet and certain policies and procedures that the credit union must have in place in order to utilize this cure provision. So credit unions should make sure they have these in place before utilizing this amendment. The NCUA made some housekeeping changes to the regulations that ended up being redundant after the CFPB's mortgage rules became effective. Specifically, NCUA Rules Part 701 and 722 were revised to eliminate the requirement for federal credit unions originating loans secured by first lien on a dwelling to provide copies of appraisals used in connection with that loan. The Equal Credit Opportunity Act valuations rule requires credit unions to provide applicants for first lien loans on a dwelling with copies of appraisals as well as other written valuations developed in connection with the application, whether or not the applicant requests copies. However, federal credit unions should be aware that the NCUA rule still requires the federal credit union for loans secured by a subordinate lien on a dwelling to make available to any requesting member or applicant a copy of the appraisal used in connection with their application for a period of 25 months after the applicant received notification from the credit union on the action taken or the outcome of their application. Credit unions should make sure they have applicable policies and procedures in place to address these revisions. Now that we've covered the revised rules that have already become effective, let's talk about the upcoming effective integrated mortgage disclosures and highlight some key points that credit unions need to consider when revising their policies and procedures. The loan estimate replaces the early truth in lending and good faith estimate disclosures. The loan estimate must be provided to the borrower within 3 business days of receiving the application. Pay attention to the definitions in the new rules, specifically the definition of a business day, because it is different when you're dealing with time frames for the closing disclosure. Also, the definition of an application is important because when all of this information is received by the applicant, no matter the form that it takes, the credit union is deemed to have received an application and the timing begins for that 3 days. The closing disclosure replaces the final truth in lending and the HUD-1 disclosures. The closing disclosure must be provided to the borrower within 3 business days before consummation. As I mentioned before, the definition of a business day is different with this disclosure than it is with the loan estimate. Of course, CFP has to keep us guessing. Here, the definition means all calendar days except Sundays and legal public holidays. The definition in a loan estimate is a day on which the credit union's offices are open to the public for carrying out substantially all of its business functions. So under the business day definition for a loan estimate, which we just talked about, your credit union may not need to count a Saturday. However, for purposes of the closing disclosure, you actually would. Unfortunately, we don't have time to review the nuances of the integrated mortgage disclosures in detail because we would be here all night. However, we did want to highlight some important considerations for your credit union. August 1st is approaching fast. Make sure your lending system providers are in the process of making these changes. Make sure that you have time to train your staff on the changes and the new time frames. Also make sure your system is able to handle loan applications received on July 31st, 2015, and those received on August 1st, 2015. The CFPB has said that credit unions cannot use these forms, the new integrated mortgage disclosures, prior to August 1st, 2015, the effective date. Therefore, you need to make sure your systems will be able to simultaneously provide disclosures for loan applications processed the day before the effective date. Let's now review some of the hidden compliance requirements that were part of the integrated mortgage disclosures rule, but didn't get a lot of press because the weight of the mortgage disclosures really took the abundance of that highlight. So let's talk about those. Within the Integrated Mortgage Disclosure Amendments, there is a restriction on fees. So credit unions cannot impose a fee on a borrower in connection with an application until the borrower has received the loan estimate and indicated an intent to proceed with the transaction. This does not include fees for a credit report, so there is an exemption there, but it does include application fees, appraisal fees, etc. In addition, in order to comply with record retention requirements, the credit union is going to need to document the borrower's intent to proceed. The new rules also require an escrow closing notice to be provided to the member prior to canceling an escrow account. If the consumer requests the cancellation of the escrow account, the notice must be provided within 3 business days. You'll notice the business day definition coincides with the closing disclosure definition. If the credit union determines to cancel the escrow account, the notice must be provided to the borrower no later than 30 business days. There is a model form provided in the regulation, so always credit unions are encouraged to use that in order to guarantee themselves compliance. If the regulators are giving us a model form, we really need to take advantage of it and use it. Lastly, the new rules require the credit union within their mortgage servicing transfer notice to include information related to the partial payment policy that will be applicable to that loan. Again, a model of the disclosure notice is provided within Reg Z. We are encouraging all credit unions to use that model language. Thank you for joining me at the CU Compliance Connection, and stay tuned for future broadcasts on issues that affect your credit union. We are here to help you at the CU Compliance Connection by InfoSite, only on Cube TV.
Cube TV is powered by CU Solutions Group. Stay tuned.